BlackRock, they don't sell annuities. They got $14 trillion in the market, more than Fidelity, more than Vanguard. You get 22% more spendable income, plus you're more willing to spend it because it's guaranteed for life. The research shows that people who own annuities are happier than people who don't. Who are your happiest clients in retirement? It's your firefighters, your nurses, your teachers, people with pensions. And pensions are lifetime income annuities. So you're happier, and now the research shows you live longer.
Retirees still have 80% of their money after 20 years. And on one hand, you would say, oh, that's really, really good. But why is that potentially a really bad statistic to look at?
Everybody worries about clients running out of money. Well, the truth is most clients never spend anywhere near what they should. Most millionaires die millionaires. They don't die broke.
If someone's pitching you an annuity or insurance on the accumulation phase, like as a replacement to your investments, run because you're getting scammed. But there's a difference between distribution and accumulation. Why is that so difficult for the internet pundits to figure out?
Distribution is all about having income. It's not about assets. The stock market is not a great income producer, okay? It's volatile. It goes up and down. It's not made for retirement. It drives me crazy when people buy annuities to leave money to their kids. That's not what I'm doing. I'm buying annuities for me. The annuities are for us, my wife and I. The life insurance goes to the kids. But there's a lot of fiduciaries who won't use annuities, won't use life insurance. They say they're acting in their client's best interest. I mean, this is malpractice that's going on out there.
Tom Hegna, welcome back to the show.
Hey, Caleb, great to be back with you.
So annuities are, record high sales, and some people would call this the $10 trillion opportunity. You've had a couple LinkedIn posts that have gone pretty viral. One on BlackRock, and when I think of BlackRock, I don't think of anything annuity-wise coming out of anything that they write, because when I think of BlackRock, I'm thinking real estate, investing, all of that stuff. You had a post on LinkedIn that you posted last week, and it has 53 reposts and over 200 likes and shares. Let's dive into that, and then I'll go over another post that has gone viral for you recently. But I feel like you've been talking about this for 30 plus years, and it seems like more data is starting to just say, Tom's been right, Tom's been right, Tom's been right.
Well, because the math and science doesn't lie. It's like saying, oh, everybody's saying the sky is blue. Yeah, because it is, or that the earth is round. Hey, it is. And so, all I speak about is really the math and science. And BlackRock, they don't sell annuities. They got $14 trillion in the market, more than Fidelity, more than Vanguard. But they got a lot of smart people, and they use AI. And if you go to AI says you need to use guaranteed lifetime income in retirement because you do need to. And BlackRock says why. You get 22% more spendable income, plus you're more willing to spend it because it's guaranteed for life. Everybody worries about, clients running out of money. Well, the truth is most clients never spend anywhere near what they should. Most millionaires die millionaires. They don't die broke. They die millionaires. And so you're supposed to spend money in retirement. That's what it's all about. You're supposed to spend money. But savers like me, I've been a saver, find it very hard to spend money. But when you got these paychecks and playchecks coming in, guess what? Now you feel like you can spend, and you can spend more than a 4% withdrawal from some portfolio because these payout rates are incredible right now.
Yeah. There was in that article, it said 80% of pre-retirement savings, like pre-retirees, still have 80% of their money after 20 years. And on one hand, you would say, oh, that's really, really good. But why is that potentially a really bad statistic to look at?
Well, because you're not supposed to give your kids any money. You are supposed to spend your money in retirement. You say, what's a 401k for? It's for your retirement. What's an IRA for? It's for your retirement. It's not for your kids. You're supposed to spend the money and then leave them life insurance. That's what we did. We bought life insurance for pennies on the dollar. When we die, that goes to the kids. We get to spend our money. And because I have 13 annuities, I got all these paychecks and playchecks coming in, I'm willing to spend those. I don't have to tap into my other investments. And that is what the research shows you should do. You should have a 20 to 40% of your retirement portfolio into guaranteed lifetime income. That still leaves plenty of room for liquidity. It leaves room for investments. It leaves room for other things. But you want to have that foundation. Lifetime income products are a foundational, play a foundational role of a retirement plan.
I believe the article talks about having the goal is having 30% of your portfolio into some type of annuity or guaranteed income, and then 70% in stocks, bonds. What is your thoughts on their take there? Again, I know
Yeah.
BlackRock is like, what is your take on that?
I support that. What they're saying is if you have some guarantees, you can actually be a little more aggressive in your other investments and make more money. I've done the same thing. I think we had another conversation where I used to be the biggest Bitcoin non-believer in the world, but I watched this guy, make a believable case to a non-believer like me that Bitcoin can hit $1 million a Bitcoin. And he said, we just recommend people put 1% of their portfolio in there. Because if it goes to zero, it won't hurt you. If it goes to $1 million, you're going to be happy you did it. That resonated with me, even though I'm a very conservative investor. I put 1% of my portfolio back when Bitcoin was $2,000 a Bitcoin. It's been by far my best investment I've ever made. But because I've got so much guaranteed, I can take a little more risk if I want to.
Mm-hmm. Mm-hmm. Oh, the other LinkedIn post that you shared recently that really resonated, and I think this is pretty much the essence of your thesis. You can correct me if I'm wrong, but you wrote, if you don't use an income annuity in retirement, I can promise you one of two things will happen. Number one, you will spend too much money and eventually run out. Or, most likely, number two, you won't spend enough and you'll never fully enjoy your retirement. The income annuity provides the highest guaranteed income in the market and pays you as long as you live.
Yeah. I mean, think about it. That's what's so neat about the annuity. I almost call it like a mini miracle. Like the insurance company doesn't know when I'm going to die, and they don't know when you're going to die, but they know how long 1,000 people are going to live. And because of that, they can pay each and every one of those people as though they knew exactly when they're going to die. Every single one of those people will get the highest guaranteed paycheck possible for the rest of their life. I mean, so if you don't use one, you're either going to spend too much money or you won't spend enough. The annuity will guarantee you'll spend exactly the right amount of money. I mean, at least it'll give you that income that you can spend.
Yeah, I think the BlackRock article, there's a lot of statistics, but it was pretty clear that the people that they talked to wished that their employer offered some type of guaranteed income. And I was thinking about this. If we gamified, this is how it should be, how much money you save and you literally see your retirement income increase. So it's like, hey, I'm saving and I'm buying future income. For some reason, there's a disconnect, rightfully so, because you have your money in your 401k or other accounts, that doesn't always translate into more income because there's that disconnect. And so I'm curious from the psychology standpoint. And then I want to play devil's advocate and talk about why right now in 2026, there are so many pundits, especially, that hate on annuities and almost make you feel like you're getting quote unquote scammed. But then I just feel like you're gonna live longer. You think you mentioned that, you're just gonna live longer, healthier. And even for me, I'm as entrepreneurial as they come. I'm a hardcore entrepreneur. I take stream income all day long because of what that frees me up to do in creating. I know I threw a lot at you, but I'm just curious your take on what I just mentioned.
Well, I don't see that many people hating on annuities anymore, really. I've seen the tide turn almost 100%. I think the people who are saying annuities are bad or a scam, they're the ones that have the weak hand. They don't have the strong hand. I got the strong hand. The people who are pro-annuity have the strong hand. BlackRock. Now you got Ernst & Young, an accounting firm. They don't sell any annuities. They say the perfect retirement portfolio has 30% cash value life insurance, 30% income annuity, 40% investments. Barclays say fixed index annuities outperform bonds. Roger Ibbotson did a whole white paper that shows fixed index annuities outperform bonds. The problem is some agents are comparing annuities against stocks. That is not the comparison. Annuities against bonds. Just go for the bond portfolio. In fact, that is the simplest way for anybody, even annuity non-believers would say, okay, I'll give you my bond portfolio, okay? Because they know that the annuity, and they can see the numbers, the annuity is going to outperform the bond portfolio because of the mortality credits and all of that. And so if advisors would just focus on the client's bond portfolio, replace that with annuities, I think the world will be a much better place.
Okay, so talk to me about how annuities and life insurance fit into someone's portfolio, because I will say this, some of the same people that talk about especially whole life as a bond alternative. And so a listener could be like, okay, I'm confused. Is it either or? Do they blend together? What is your take on that?
I do both. I just finished a 12-pay whole life. My premium was $226,000 a year, so I'm serious about. I moved a lot of my wealth into cash value life insurance, and that is a great bond substitute as well. But it's also got huge tax advantages. I can now take out 10, 15,000 a month tax free for the rest of my life. Whenever I want to flip that switch, I mean, doesn't that give me some amount of freedom to know that, no matter what the market does, and I've got money in the market too. It's not like I got everything in annuities and life insurance, but I probably got 60%, 30% annuity, 30% life insurance, 40% investment. That'd be pretty close. If you looked at my portfolio, it'd be pretty close. I mean, it might be 5% off one way or another, but it's pretty darn close. And it gives me the most flexibility. It gives me the best tax advantages. Now, if somebody thinks taxes are not going up in the future, they might think I'm stupid. I happen to think taxes are going to have to go up a lot. We're $40 trillion in debt. The debt's climbing every single day. Now we're involved in a thing in Iran. That's costing a lot of money. And at some point, the madness is going to stop. And we were just in Greece I was just on a cruise, and Greece went through a huge financial problem 10 years ago, and they cut everybody's Social Security and pension by 50%. Now think about that. 50%. It really happened to them. And if you look at what happened in the Great Depression and things, when things just went crazy, and they took people's gold back then. I mean, stuff can happen that people aren't expecting. And I just want to have some safe places that no matter what happens, I'll be okay.
Hey, I want to interrupt this video real fast to tell you about our Clarity Call. We designed this Clarity Call for the entrepreneur, the high-income earner, the person that wants more control, the person that is ultimately asking the question, how can I better my finances? And this Clarity Call is simple. We get clear about your situation, and then we try to answer the question, does integrating overfunded whole life insurance help you better your financial situation? Does it help you be more efficient? Does it help you better accomplish your goals? If the answer is yes, we'll actually show you how it does. We can walk you through those steps on what it would look like to getting permanent whole life insurance in your financial situation. If the answer is no, you'll have clarity on this is not the right fit for you. And so if you're someone that's been wondering, does the strategy work? We've designed the Clarity Call for you. No pressure, no fluff. We just, again, want to help you get real clear on, is the strategy a right fit? Make sure to click the link in the description or the pinned comment below. Let's get back to the video. When you mentioned, when we first got on before we hit recording, you were like, people are living longer with annuities. Talk to me about the health aspect, because if there's one thing that I'm probably more passionate than anything, it's probably the health side, because I think it fits into your spiritual life, it fits into your financial life, it's integrated, and it made so much sense, but I don't have the data to back it up. So I'm curious on what you're referencing when you say annuities help you live longer.
Well, if people go through my LinkedIn, it was just maybe a week and a half ago. It was probably right after the BlackRock or right before it. I published another study that shows that people who own income annuities live longer. Now, Freakonomics already put out something on that. The University of Chicago did a study, and they found that people who own income annuities live longer than people who don't. Attorney Patrick Tricker wrote an article for the Journal for Financial Service Professionals that says the average 65-year-old male who purchases a lifetime income annuity can expect to live 20% longer than the 65-year-old male who does not. So what I always say is there's 3 reasons why you want to put an annuity into your retirement portfolio. Number 1, it will improve portfolio performance because it'll outperform the bonds because of the mortality credits. Number 2, the research shows that people who own annuities are happier than people who don't. Because just think about it. Who are your happiest clients in retirement? It's your firefighters, your nurses, your teachers, people with pensions. And pensions are lifetime income annuities. So you're happier, and now the research shows you live longer. So if something improves your portfolio performance, allows you to be happier, and allows you to live longer, how could anybody be against that? And if they are, I'm just telling you, they're going to be on the wrong side of history. And you can go to AI, you can ask them, hey, what do you think about Tom Hegna? You think he's okay? And AI fully supports what I say. And AI knows me. They know my voice. So when I ask them to help me write a post, it's in my voice. It's incredible what AI can do.
Yeah, I just found the LinkedIn post. You said 600 retirees, one finding, guaranteed income helps you live longer. The National Bureau of Economic Research just published research showing retirees with guaranteed lifetime income stream were less likely to die over the next decade rather than the ones that were living off of lump sum. If you just think about the stress, I'm learning more about like the vagus nerve, and like I'm tracking my HRV. And what I found is if I'm more stressed, my HRV is lower, and that hurts my recovery. And I can just imagine some people might be designed to like try to maximize every dollar. But the people that have lump sums and they're afraid, like if the market goes down and all, they're hedging. They're putting a lot more energy into something that they can't really control. So it does make sense. I just I think this is where this was the shoe that I think is going to make a lot of people big time believers. So then on the flip side, you get people that say, well, what if you could just like get a better rate of return? And you just mentioned the biggest misconception is annuity is not trying to compete with investing. And I find that the same thing with insurance, where people usually get this thing wrong, is when they compare the product in accumulation. So they're like, well, if someone's pitching you an annuity or insurance on the accumulation phase, like as a replacement to your investments, run, because you're getting scammed. But there's a difference between distribution and accumulation. Why is that so difficult for the internet pundits to figure out? Because I do believe that majority of advisors get it, but still the people that are speaking the loudest seem to be in love with index funds, don't do any insurance product, or you're getting ripped off.
Yeah, but they totally misunderstand it. And distribution is all about having income. It's not about assets. And stock market is not a great income producer. Okay, it's volatile. It goes up and down.
Yep.
You know, it's not made for retirement. And I'm not saying don't have money in stocks. I have money in stocks. I have money in Bitcoin. I have money in the real estate. You know, I have multiple things, but the foundation of any retirement should be guaranteed lifetime income. You'll be happier, you'll live longer, your performance will be better. And one of the reasons you live longer, yes, there's less worry, there's less stress, but now you're being paid to live. So guess what? People choose to live differently. They watch what they eat, they exercise, they call the doctor when not feeling well. And, you know, all of this matters. And when you're happier, you live longer as well. So, I mean, it all fits in there. And any pundit out there saying that annuities are bad, they are on the wrong side of history. They're going to be embarrassed in 5 years, you know, when it all.
All right, Tom, I'm going to ask you to do something very difficult.
Okay.
I'm going to ask you to play devil's advocate with your own message. And if you've written many great books, you've spoken on many great stages, you have people using your stuff to probably promote something that would make you cringe because they're taking your message and maybe perverting it. Is there anything that you're seeing in this space, especially around annuities, that make you cringe or that you want to call out?
Yeah, and kind of in the fixed index annuity space, there have been a lot of bad indices. I'm not saying a lot of bad annuities. I'm saying a lot of bad indices that they made up these new indices and they didn't back test, or they back test them, but they're not real. And people have put their money in there and the market goes up 28% and they get credited, 0.2%, or they lose 1%, or they get 2%. And that doesn't line up at all with what they're thinking. Like when you and recommend a purchase of something, you should make sure that it's going to meet or exceed their expectations. And many of these indices have underperformed. And I'm working with somebody right now who's developed what I believe will be the number one S&P 500 index in the fixed index annuity space. So more to come on that. But I think that is the thing that concerns me the most. MYGAs are pretty straightforward. I don't think there's many misrepresentations in MYGAs. It's a guaranteed for the entire term. That's pretty simple. SPIAs and DIAs are pretty simple. I don't think there's much misrepresentation there. Where you get the misrepresentation is probably in the fixed index annuity space and maybe in the VA space sometimes. Although, I think VAs get too big of a negative hit. Yes, they have high fees, but they have some incredible features as well. And so when everybody, hates on VAs, I think they don't understand the VAs either, because there is a place for them. I have a VA as well, and it's done very, very, very well.
How young would you recommend someone get an annuity?
Well, if it's an income annuity, anybody of any age can get one. There's no 10% federal penalty on a SPIA, but SPIAs aren't attractive to young people. So I would say any age can do it as long as that money's for retirement, because really annuities are for after 59 and a half in almost all cases, not all cases, but almost all cases, 59 and a half. And so, but let's take a look at you, Caleb. I just put out a piece that showed if a 40-year-old put money in a deferred income annuity that at their age 65, they're guaranteed 33%. So now think about this. If you took $300,000 and put it in a deferred income annuity to start your income when you're 65, you'd be guaranteed $100,000 a year for the rest of your life. I don't know. If you had an extra 300K laying around, wouldn't that
Yeah.
be something that would be nice, would give you some confidence, and then you just save and invest on top of it? I mean, I think it makes sense for younger people to
Yeah.
think about their future income.
Yeah, because I mean, just hypothetically, you could buy. Let's just say I'm hoping to have way more than $1 million when I hit retirement. So let's say you take a chunk and you buy 400, 300, $400,000 of income. And again, I'm talking 35 years out, so with
Yeah.
inflation. But now, boom, if you have that, it's like a emergency fund on steroids. Would I rather have $1 million at retirement as my emergency fund or a guaranteed 350 for life?
Yeah.
I mean, it puts perspective on an emergency, and then one of the potential negatives with an annuity might be legacy, but that's why life insurance integrated well is your perfect 1-2 punch.
So you wanted me to criticize my own stuff, and
Yeah.
I say that the stuff that I get criticized on is people say, well, but then you're spending the money and there won't be money for the kids. Well, the annuity's not there to leave. It drives me crazy when people buy annuities to leave money to their kids. That's not what I'm doing. I'm buying annuities for me. The annuities are for us, my wife and I. The life insurance goes to the kids. Okay. I tell people all the time, you are not supposed to leave your kids any money. You are supposed to spend your money. Leave them life insurance. We bought $1 million secondary policy for $150,000. That's 15 cents on the dollar. They get $1 million tax free, and plus now I've got 5-6 million of that whole 6-7 million in that whole life. So I mean, there'll be plenty of money. Okay,
Yeah.
for the kids. They don't need my money. They're going to get life insurance. Okay,
Yeah.
that's the most efficient way to do it.
This might be too personal of a question, but what happens if you just have too much money coming in per month? I know, and that sounds like a dumb question. Do you just invest the difference? Do you give it away? And then what does the research show? Or is that like a I'm rich problem and that we don't even need to talk about? I'm just genuinely curious because you do get to a point where I know you're not like a crazy spender.
No.
You're not and I know that you've done the type of planning where you've got to have cash coming in that's pretty impressive each month.
Yeah, well, what the deal is, I'm trying not to save money anymore, honestly, because I mean, why? I'm 65. Why should I be saving any money? Really, seriously, I've got enough money, I think, so I'm just turning it into income. But my wife and I are traveling. I'm super tithing now, so I'm giving 20 instead of 10. To think 10's hard, try 20. So I mean, we are giving money, we're spending money, and I'm walking the walk of everything I've talked about. I don't just talk all these. This is how I'm living. Everything that's in these books is how my life is. Okay, and I use this to build my wealth. So I mean,
Yeah.
everything I read about and speak about is stuff that I've done or am doing right now.
Yeah, I love it, and your golf game will improve as well as your pickleball game. So that's you'll have more time to focus on the things that really matter. All right, I'm going to hit you with another question that you may have not done a ton of research on, but I'm just curious your thoughts. I just interviewed a guy by the name of Tom Gober. The interview just released on my show yesterday, and he is looking at insurance companies and looking at some insurance companies and starting to ring the bell and say, hey guys, you're making lifetime promises and your books don't reflect that. And so he has no problem with annuities. He has no problem with life insurance. He actually loves this space so much. So he's one of these people that aren't just saying these are a scam. He loves them so much where he gets angry is these insurance companies that are making lifetime promises but might not be there to show for that. Have you done much research on that? And do you have a comment on what someone can do to make sure that they are with a company that is rock solid?
Yeah. So I even commented on this. If you look through my posts, and I think I commented on his post, that Larry Rimka has done a lot on this. Carrie Pector has done a lot of research on this. They're the voices that are out there really ringing the bell. Bobby Samuelson, they're ringing the bell. Hey guys, got to be careful. There's private equity companies or insurance companies, and they're investing way different than a AAA mutual invests, and they're offshore and it's Cayman Islands and all this other stuff. So I think I think it could, if there's a big financial crisis, it could be a huge problem, and it's a reputational problem that would affect the AAAs as well. Because if insurance companies start failing, then the entire industry gets a bad name. So, but I say in my books, all insurance companies are not created equal.
Yep.
Every advisor has to pick their level of what level their risk they're willing to take. Most of my contracts that I own are with AAA mutuals. Not all of them. I have some in the other space. I even have one or two that are probably one of those private equity owned companies. So, I mean, I'm diversified, but
Yes.
I think you need to be careful. And that's another reason why maybe you keep the annuity sales at the 250, 300,000 per contract level, so that they still have the state guarantee funds that could help if there was a real bad situation.
Why don't you talk about that? Because that sounds like a pain, but I know that it matters, and like why potentially having some small annuities with multiple carriers could be different than having all
Yeah.
of your money in one thing. You might lose some efficiency, but you might pick up some diversification that could be helpful.
So, Dr. Michael Finca and Dr. David Blanchett just kind of did a white paper on this, talking about how people don't know about these state guarantee funds. And part of the reason is you're not really supposed to talk about them with clients, but they are there. It's kind of the insurance industry's FDIC insurance. It's the states guarantee up to a maximum of 250,000 or 300,000 per. I believe it's per contract. Might be per person. I'd have to check that. But you could do one on yourself, one on your spouse, one joint. Those would all three be protected. And I think each contract is protected. We'll have to look that up. But that gives you some additional protection that if the insurance company, and by the way, most annuities have such high reserve requirements that there's going to be money there to go to the people. It's not like all their money's going to be gone. That's not a very likely scenario. But I would say, keep it within those state guarantee funds when you can, and that just gives an extra layer of protection.
Yep. No, I agree. And just to go off of what you're saying, I've talked to people that will do the smaller annuities because per contract they're giving their clients that extra protection, which I think is awesome. Tom, I drilled you with so many questions, and you are a very efficient talker. Anything else that you want to say as we land the plane? It's always an honor to have you on, and I'm just so grateful that I can call you a friend.
I just think that agents and advisors can't be ashamed of insurance and annuities. These are great products that help people, and you just got to get better. Follow Tom Wall if you want to sell whole life. He's a great person to follow for whole life. Follow me for ideas on annuities and guaranteed lifetime income and stuff, and kind of know who the key players are that you can follow that are going to share with you valuable information that will help you in your business and give you the confidence. See, I've got 100% confidence talking to anybody about annuities. I know it in my heart. It's not just in my head. I'll tell you a quick story. So I was in New York just a week or so ago, and I was filming 10 episodes for CNBC on this Moving America Forward series that William Shatner started. Well, I was having breakfast in the morning with a couple other guys, and there's this guy over there who's listening to us talking. We're talking about annuities, and he goes, "Oh, annuities are a scam," and he just started railing on it. And the two guys with me started trying to convince him that he's wrong. I just got up, I walked over, I sat and had breakfast over there by myself, because I learned that this guy is not somebody who's even got an open mind, who will even listen to the facts, and a man convinced against his will is of the same opinion still. So you kind of got to know when to hold him and when to fold him. And I'm not going to argue with some guy who knows nothing about nothing and he's just spouting off. That'd be non-productive for me. So if people are really interested in retirement, they want to know the right way to retire, I can help them. Some people think they know it all and they're going to do it. Them, fine, let them do it. It's a free world. I can't fix everybody, but I can fix anybody who wants to be fixed.
Yeah, no, I like I mentioned earlier, health is really important. And if we can start having the conversation about accumulation versus distribution, and then just simply asking, what helps my legacy? What helps me potentially live longer? What, like, the big risk in retirement is running out of money or that volatility. If you can create something, I could almost make the argument that you could have a greater legacy, because instead of you locking up or having, I think as Curtis Cloak talks about, like, and you probably all take these things from each other, but like all your money being held hostage.
Right.
Create 20 or 30% of your money, lock it up, free up 70%. And oh, by the way, what does that look like over the next 30 years or plus versus having all your money being, quite frankly, inefficient because it's all kind of having to be used? I could make the argument that you'll have a greater legacy by applying insurance products like annuities. You'll live longer. The data is pretty clear about that, but that you also spend more money. So it's like spend more, live longer, give more away, be willing to change your mind because this happens to be an insurance company that you would have to work with. And if that breaks your brain or your ego, then do it your way and see how it all works out.
Yeah. And, people harp on liquidity, oh, there's no liquidity in that. Liquidity is not a one-time event. Liquidity is a lifetime event. When you add guaranteed lifetime income, you are increasing your lifetime liquidity. Besides that, nobody's saying put all your money in annuity. We're saying 20 to 40%. That leaves plenty of money elsewhere for liquidity and other things. So I don't think, if I try to criticize my own thing, it's hard to do because mathematically it is the optimal way to do it. And so people can do it other ways, but they're going to be suboptimal. They're going to be less than what they otherwise could or should be.
I think just like if I had to criticize the insurance space, that the same thing could be true with annuities. Some people can be way too aggressive. They could put all their money in one contract. Potentially that contract pays them a lot of money. So it like in everything, it's not a straight up pass, but it's a integration. And that's the word I've been trying to use more is integrate, understand how things integrate together. Reverse mortgages is another one of those things that can be misunderstood. But there's some bad actors. There's some people that make the stereotypes right.
Absolutely.
But it's another thing where it's like, don't get triggered, learn how this thing potentially could integrate. And as a result, it could give you a better outcome.
But there's a lot of fiduciaries who won't use annuities, won't use life insurance, won't use long-term care insurance. They say they're acting in their client's best interest. They're telling them not to buy long-term care insurance. They're saying, oh, you got enough money in your account, just fund it out of here. This is malpractice that's going on out there, and they're claiming to be fiduciaries. They have a conflict of interest because if people take money out of their portfolio to buy these products, then their paycheck goes down. And so that's the big conflict of interest. They always say commissions are bad, fees are good. No, I just put out a video just showing the math. The commissions are far less to the client than these fees. So
why don't you talk about that? I was going to ask you that since you brought it up. If someone annuitizes a portion of their income in an annuity versus keeps that in a portfolio, what is the fee breakdown over 10, 20, 30 years? Because I bet you paying a one-time commission is going to be a lot cheaper than a potential 1% every single year.
Especially since the insurance company pays the commission. The commission doesn't come out of the client's funds. I mean, certainly the product's priced to pay a commission, but it doesn't come out of their account value. The fees come directly out of their account value. And it, over 20 or 25 years, it can be hundreds of thousands of dollars in fees and hundreds of thousands of dollars of lost performance because those fees aren't being invested. And so, I got a whole video. It's going to be on YouTube. You can have people go look at it, but I'm exposing these fake fiduciaries. Now, I love fiduciaries, and I'm not against fee providers either, but the ones that are saying, oh, you got commission breath or all this kind of crap, they got fee breath, I guess. I don't know, but I'm trying to expose some of the fake fiduciaries. I like the fiduciaries who say all the tools are available. Every tool might fit. Yeah, Bitcoin, it might work for some people. Annuities might work. Your life insurance, long-term care, investments. All the tools are available. I'm fine with it. And I'm not fine if they say, oh, they're all available, but I never use them. And I always ask these fiduciaries, okay, how many annuities did you write in the last 12 months? Oh, no, I don't do it. Oh, how many life insurance? Oh, I don't do that. Oh, well, then you're not a fiduciary. In my book, you can't be.
I'm sensing a future book, The Fake Fiduciary by Tom Hegna.
I get haters all the time anyway.
I like it. It's very in your face. And then you could say, you could do like a quiz. Is your advisor a fake fiduciary? We might have to do something with that. Give me a call if you want to collaborate on that project.
We could do that.
Tom, you got 40,000 plus followers on LinkedIn. That number's got to go up. So if you're watching this and you have a LinkedIn, make sure to go follow Tom. You're also on YouTube. I have to just say, I am so proud of you for being even more active and more vocal in your retirement. You said yourself, 65 you're spending
Seven,
your money. It would
seven.
be easy for you to say, see you guys, like I have content, read my books, all this stuff. You are more active than you've ever been. And I just want to thank you for that, because people like myself very much benefit from people like you who have not only built a strong foundation, but are there to support. So thank you.
Yeah, well, one of the reasons is my son, who just is coming out of the military, who's just over in Poland and Germany for a year, just got back. He's going to be taking over as my chief operating officer. So I'm just trying to reignite some things to get some more revenue coming in and help more people and train more people. And so, I'm still going to play a lot of golf, but I'm just, for this year, I'm just pumping a little extra in there.
I love it. If people are interested in learning more about how they can get plugged into your world, what's the best way for them to do that?
Yeah, go to tomhegna.com. Go to my YouTube channel. I got a bunch of free webinars at tomhegna.com/webinars. That'd be a great place to start.
Okay. Tom, thank you so much for coming on the show. You're welcome anytime.
All right, Caleb. Good seeing you.